After hitting an all-time high of about 86,000 on September 26, 2024, as of February 28, 2025, the Sensex has corrected by about 15% and dropped to about 73,000. This situation is rather grim for mid and small caps. Mid caps have crashed about 22% from their peak and small caps by about 25%. Now, in the past, amid the market rally of the last couple of years, we assessed market valuations on two occasions. On both occasions, the markets weren't cheap. But post the recent correction, are they now? Hello and welcome to ET Money's YouTube channel. In this video, we will check 4 metrics to assess the market's valuation. Now, this data will help you figure out if the market correction has run its course or if there is more pain ahead. This insight can then help you plan your portfolio moves better. So do watch this video until the end. Now, this video is part of our market trends playlist. If you'd like to watch more such videos, you can check the playlist. The link is in the description. So let's start with the first valuation metric. Okay, the first question that would have come to your mind is why not talk about PE or the price to earnings ratio, which is a frontline indicator to check valuations. We will be talking about the PE but in a different way in a later section. But we won't be talking about the classic PE metric. That's because the PE ratio uses earnings to calculate valuations and earnings can be volatile. In good economic conditions, earnings can shoot up and during bad times, they can be depressed. They also tend to get impacted heavily by market and sectoral cycles. For instance, in a recently published video on market trends post Q3, we observed that corporate earnings have spiked in Q3, but not due to business performance. So using the PE can give a misleading picture. On the other hand, the book value of a company is a comparatively more stable metric, and that's why it's prudent to consider the PB ratio. Now, to calculate the PB ratio, the stock price is divided by the book value per share. Now, at the index level, to find the index PB, the total market cap of index companies is divided by their total book value. Then this PB ratio so obtained would be compared with the historical numbers. Alright, so let's first check the PB ratio of the various market segments. Let's start with the BSE 100, which comprises large caps. Now, as against the median PB of 3, the BSE 100's current PB stands at 3.62. That's a premium of 21%. But changing economic and business conditions warrant checking the medium-term and near-term picture as well. Let's change the time period to last 5 years now. The 5-year median PB of BSE 100 is 3.37. The current PB of 3.62 is at a premium of 7%. Finally, let's also check the 3-year data for the BSE 100. The 3-year PB is 3.51. The current PB of 3.62 is at a premium of 3%. So overall, in terms of the PB ratio, the BSE 100 isn't at a bargain still, though its valuations have turned cheaper in terms of the 3 and 5-year medians. Now, in terms of 10-year median, the BSE 100 continues to be quite expensive. Okay, let's now check the mid cap and the small cap pictures. For mid caps, let's look at the valuations of the BSE mid cap index. Now, across all time frames, the mid cap index is at a steep premium to its historical median despite the recent correction. If you consider the last 10 years PB valuations, the current PB is at a premium of 44%. In terms of the last 5 years PB, the premium is 30%. And in terms of the last 3 years PB, the premium stands at 26%. Alright, let's check the status of small caps now. For that, we will use the BSE small cap index. Thankfully for the BSE small cap index, the condition isn't as bad. At 25%, while the index is still steeply valued in terms of 10-year median, it is reasonably valued in terms of 5-year median and at a slight bargain in terms of 3-year median. So overall, if we consider PB as the yardstick, mid caps continue to be steeply priced, followed by large caps and small caps. The recent bloodbath in small caps have made them attractive if we consider the near-term picture, but they continue to be expensive from a long-term perspective. Okay, let's next talk about a modified version of PE called the CAPE or cyclically adjusted PE ratio. Let me first explain what the cyclically adjusted PE or CAPE ratio is. Now, as we discussed a short while ago, the classic PE ratio uses earnings which can be volatile due to business and sectoral cycles. The CAPE ratio addresses this volatility in earnings by averaging the inflation adjusted earnings over a 10-year period. Now, this helps smooth out short-term fluctuations and get a more accurate picture of valuations. The CAPE ratio is also called the Shiller PE ratio as it was introduced by Professor Robert Shiller in 1988. Now, Joshi Jacob and Rajan Raju of IIM Ahmedabad have calculated the CAPE ratio of the Sensex based on 5, 7 and 10-year business cycles. Let's take a look at where the Sensex CAPE stands with respect to its median. With respect to the 10-year business cycle, the Sensex current CAPE of 33.7 is at a premium of 46% to the median of 23. In terms of the 7-year business cycle, the premium stands at 45%. The current CAPE here is 32.2 and the median is 22.3. And in terms of the 5-year business cycle, the premium is 39%. This is due to the fact that the current CAPE is 30.2 and the median is 21.7. So, across all measures, the market appears to be expensive. Of course, this is considering the Sensex as a proxy for the overall market. So do consider this aspect as well. Let's now talk about the next valuation metric. But before that, do subscribe to the channel if you aren't already a subscriber, and don't forget to click on the bell icon so you never miss a video from us. The market cap to GDP ratio is also called the Buffett indicator, as Warren Buffett personally likes this valuation metric. It is derived by dividing the market cap of all listed companies by country's GDP. Now, when the market cap of all listed companies is more than the GDP, the market is said to be overvalued and vice versa. Now, the current market cap to GDP ratio stands at 110%, which means that the market cap of all listed companies is still more than the country's GDP. This suggests overvaluation. However, also noteworthy is the fact that this ratio has come down from a peak of about 140% just a few months earlier. Now, if we check the market cap to GDP ratio for the US at 200%, it puts India's ratio to shame. But thankfully, it also suggests that the Indian market is not as expensive as the US market. Then, if we check the Buffett indicator for China, Chinese markets are much cheaper than Indian ones, with the current levels at just 65% of GDP. Now, this brings us to the fourth and the last indicator. The BER ratio has two components, bond yield and equity earnings yield. Now, to calculate this ratio, the yield or the expected return from a bond is divided by the market's earnings yield. Now, the earnings yield is nothing but the inverse of the PE ratio. Put simply, if the market were a bond, the earnings yield tells you what returns you would make from it. So, comparing the bond yield with the market yield can tell us about their relative attractiveness. Now, depending on the corporate profitability and the ensuing interest rates, it's normal for bond yields and market yields to deviate. However, if this deviation crosses the historical median, that could signal an overvalued and undervalued market. So, let's check the historical ratios of the two. As a proxy for the market, we have used the BSE 500. For bond yields, we have used the 10-year GSEC yield. Now, the BER ratio touched a low of 1 in March 2020 after the COVID-19 crash. That signaled a cheap market. It hit a high of 2.25 in March 2021 amid the market rally that followed the COVID crash. That level signaled an expensive market. Now, as against the 10-year median of 1.76, the current BER ratio stands at 1.49. That's a discount of about 16%. So, as per this measure, the market is currently at a discount to its historical valuations. Okay, let's summarize the results from the 4 indicators in concluding section of this video so that you can get a comprehensive picture of market valuations. In this video, we looked at market valuations across 4 metrics: PB, CAPE, market cap to GDP and BER ratio. The results from them are rather mixed. Now, in terms of PB ratio, the 3 market cap segments show different degrees of valuation depending upon what time frame you choose. The CAPE ratio suggests that the market, as represented by Sensex, is still overvalued. If we take a bird's eye view of the market cap to GDP ratio shows that the markets are overvalued, but the BI ratio indicates undervaluation now. So what should you do as an investor? Well, since the results from the 4 metrics are mixed, you cannot shun equities altogether or be 100% invested in it. So you must consider other asset classes too. And you can find multiple ways to doing so on the ET Money app. And with this, we have come to the end of the video. If you found this video useful, do share it with your friends and family. I'll be back soon with another video. Till then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.